a high likelihood of saying, okay, what is the Galileo member count Jesus Royce photo? What is the? I can't.
Is that even Roy?
That's like Roy the Tiger King.
That was me pre-COVID beard. So
There you go.
I totally lost my train of thought.
You're making a good laugh out of people, though. CFO Chris Lapointe just recently had a fireside conversation with, what was it, UBS? They talk about a bunch of different stuff. The compounded annual growth rates for the company going out to 2026, tech platform conversations about the growth.
There's one thing I'll say with regards to the LaPointe Fireside on Monday. He spent the majority of that talk on the tech platform. SoFi's management is going to predominantly talk about the tech platform on an increasing basis because it's going to be a bigger contributor to the revenue mix. Even in that UBS Fireside, he mentioned, yes, we have financial institutions, but also we have these other companies. Maybe they're fintech companies, maybe they're not even in the finance space in general, but they want that exposure. And so it's going to broaden the range of their total addressable market for the technology platform. And the more that management reiterates that, then what we're going to get is in earnings calls, analysts are going to start focusing on that more. And as they focus on that more, they're going to incorporate that into their models that they're building out and into their forecasting to essentially assign a correlation. My point is, the more management talks about it, the more analysts are going to touch on it. And the more that they model it out, the more the technology platform eventually leads them to having a hybrid valuation. And that hybrid valuation is going to be very important for the company because that adds a premium on their technology platform aspect of the business. It's good that he's talking about the intricacies, not only of like the teaser of the top 5 financial institution, but also of saying, oh, we're dealing with fintechs, we're dealing with all of these other companies as well.
Whenever SoFi guides multiple times on something, they usually end up hitting it more often. Think back to Q4 guidance being profitable, right? They were saying that for, they said it 20 different times. It ended up hitting. And then for some reason, it shocked some people that we even were profitable as if they didn't say it like 20 something times. This, I think you're going to start seeing with SoFi with the compounded annual growth rates that they keep bringing up. That is one that we're going to continuously see, reiterating their midterm guidance because there's a lot of non-believers. So I think the new SoFi is profitable in Q4 will be the EPS guidance for 2026. I think they're going to reiterate that multiple times every quarter. I think they'll hit it.
That'll be a drum that they'll just continue to beat. I still don't understand why a company that has a history of beating their guidance and beating what they say time and time again, no matter what the macro environment is, that people doubt them. But it happens, and it's to our benefit as shareholders. It's our opportunity. So,
yeah. There were some really, really interesting comments on that fireside, by the way, guys. Top 5 bank, interesting. There was a little bit more information uncovered that potentially that top 5 bank might be Citigroup or US Bank, some potentially leaning more towards Citigroup. What are your guys' thoughts between the two little rumors of who this new potential large client is?
it looks like there's more smoke on the Citibank side. But I mean, nobody knows at this point.
So I went full tinfoil hat on this, the USB versus Citigroup side of things. There's hints that push us to both directions. I mean, I think nail on the coffin for Citigroup was what Bender posted earlier this week. He'd taken a look at the DNS records for SoFi, and it literally says POC next to Citibank. That was from late 2022. It's kind of hard to dispute that. Like, I took it as unofficial confirmation, basically. And I mentioned this in a video I posted earlier this week. In my mind, that's all I need to see to say this is confirmed that at least Citi was the POC. Now, that does not mean that that POC is successful. It doesn't mean that, Citi is a client or anything like that. It just means that per their DNS records, what Bender found, that it is Citi. In terms of the UBS side of things, a lot of the connections are from a people perspective. Derek White, Galileo CEO, used to be the chief digital officer at USB. The guy who followed Derek White is also now at SoFi as a senior vice president. He also used to be the chief digital officer at USB. The last two essentially chief digital officers at USB are both senior Galileo executives now. So there's a lot of connection, especially given their role, right? They're chief digital officer. They oversee the entire technology aspect of that business. Those connections are pretty evident, and let's not kid ourselves, right? Like Anthony Noto, from his Goldman background, the entire executive team, Lapointe as well, These guys have worked at these financial institutions in the past. They all have connections to these big banks. They all sort of chat with one another, behind closed doors, and they all sort of know each other. They encounter each other in different events. They know of each other's presence at the very least. The connections that we're making from an outsider looking in, just as a retail crowd, there's an increased likelihood because everybody knows everybody, and it's just in my mind a matter of time. They have fewer people to convince because if I know Tannor and we're both in the same field and we've known each other throughout the course of our career, I have an inherent trust in that person because I've worked with that person probably as a colleague directly. As a result of that, I'm more likely to take them at their word. If they say, oh, now I'm working at Galileo and Galileo is something that's going to help you because I know the internal workings because I was in your position at USB. I think that they have a lot more clients underneath the hood that we don't know, especially if we go back to the DNS records for Citi. This was something back in late 2022. We're only finding out about it like 2 years later, essentially. And that's even unofficial. You have to think about all of these initiatives that SoFi already has well underway, we don't even know about, that we're probably going to find out about 2026 that they've been working on since today.
That's been one of the things that I think is most exciting that hadn't quite been followed through in the tech platform over the quarters of 2023. The growth was not coming in that strong, but management was saying the pipeline is stronger than ever. People were not putting the connections together of going like, okay, but where are the clients? But the sales cycle is so long. That pipeline could have been Citigroup and a handful of different regional banks and different, now what they were talking about on Fireside Chat, there has not been a lot of top brands and large non-financial institutions that have chosen Galileo's program. Not at least that I know of. Potentially now we could be fighting for a space that maybe we hadn't really been in before. So to give a couple examples, Marqeta owns Coinbase's card program or Uber's card program. Right. That's especially one that really fits that bill. You potentially have a company that is not directly in the financial space, but also has an ability to have a card program for their drivers because they can spend the balances that they've accumulated. If SoFi can then start going after those top brands, this could be a really big deal, right? And some of those top brands that maybe people should start looking into is like Target, for example, having one of the most successful card programs that exist today called the Red Card, Target's Red Card. Trying to go after brands that maybe aren't financial institutions is also a massive market. So the total addressable market just keeps expanding. And now we just need to wait for that funnel to actually start paying some real dividends for us. And hopefully companies like Citigroup and everything start getting the ball rolling. If we've been seeing low teens growth rates in the tech platform, they think it's going to be 20% this year, 25% CAGR throughout 2026. There's going to be some real expansion in growth rates going forward. So I'm excited to see that.
As a reminder, nothing's guaranteed. So just because it's in the pipeline doesn't mean it'll actually come out the other side and be a client. But I think there's a good likelihood of it. Yeah, it takes a while. You'll see times and quarters where the tech platform is just flying, and other times where seems like nothing's happening. So just be patient. That's just the way it is with some of these companies that they have. SoFi is no different with their tech platform. But I'm very excited. Do you think that will be made clear as far as who the partner actually is if it comes to fruition? No,
never. They're probably going to get a slap on the wrist for saying top 5 bank. I don't think that they want that to be known. And one thing, I think that this is almost purely for core migration. It's not like Galileo is going to get the full buck here. I wish they would, but Citi is like, I think, the number one debit processing company in America. I think they're even higher than JP Morgan. Yeah, I don't think that Galileo is going to win the card program considering that Citi is like the largest competitor to Galileo. So I think this is just going to be for core migration. So people need to keep that in mind, but it's still a heck load more in revenue. It just might not look directly straight to accounts that we see that they post on, the 145 million. But revenue per member will go up or revenue per account.
Oh yeah, like we'll see it. We just want to know who it is.
Yeah. Ally ended up lowering their APY on their money market funds. I think it was from 4.4% to 4.35%. Not a large cut, but you can kind of see where the trend is starting to go. So this is the first tiny little domino to fall. We'll see if this creates more in this area, and then potentially the checking accounts and these sorts of things will start to come down right after. But will SoFi stick to their word and keep it high at 4.6%? Tevis.
I mean, not for too much longer than the rest of the bunch, but yes, I believe that they're going to be one of the last, if not the absolute last, to lower it. And we've talked about this before, the vertical integration that they have and the flexibility that they have to keep the APY rates higher for longer. It benefits them, right? Because whatever they're going to lose from profitability perspective by keeping it higher when everybody else is lowering, they're going to gain from the entire cohort of users that want to leverage a financial institution or a bank that has the highest APY out there. Like there's a ton of people that chase APYs. And if SoFi has 4.6, while everybody else is lowering it into the threes and into the twos, a higher chunk of people are going to go to SoFi.
What about the point reduction that SoFi just put out where they took away their, weekly login bonuses? They were saying that they're restructuring their rewards. A firm actually just came out like probably 2 weeks before SoFi did, saying they were doing very similar things, restructuring their rewards. But now SoFi has done, I think it's the weekly bonus. That comment said daily, but I think it's the weekly bonus or something that they've completely removed from the app. I'll see some more confirmation from people, but yeah.
Look, at the end of the day, if we take it one level higher, it's all a pendulum between profitability and member additions, right? The member benefits. And we know that over the past 2 quarters that they've been focused nonstop on profitability. That importance is going to be reduced somewhat because in Q2 and Q3 they're going to be profitable enough where they don't need to make such drastic trade-offs. They might turn the spigot back on to getting as many members as they can, right?
Yeah, I think that they're definitely going to keep it up higher, and I think that there's going to be others, that like Ally Bank will slowly but surely lower that. But I think Robinhood, I think SoFi as well, and several others will just say, you know what, we're profitable, things are fine. We want to keep the inflow going, and they'll benefit actually inordinately from the falling rates as others lower and they remain the same, because some people do absolutely chase the yields. So the main thing is the gap profitability, like you said. And
let's talk about short interest. Short interest number had just increased to 17%.
Short interest numbers came out on Tuesday, I believe. 17% afloat, new record, 158 million shares sold short. That's a 33% increase from the January 12th number. It's funny because the short interest has increased more in a month than the actual stock price has increased in that same time period. 8 million shares increased from the latest filing that we had, which is the January 31st. One thing to note is that we are at a 2-week delay for short interest numbers. So this number is as of February 15th. A lot of those people could have already been covering since that time because it's been 2 weeks and the stock price has gone up in that time. We're going to get the updated filing for the end of February on March 11th.
What do we not know? Why are they shorting? Why do these institutions feel so comfortable betting heavily against a company that's doing well?
Simple bear thesis: you can't spell bankrupt without bank, and SoFi is just a bank. Not quite that silly, but one thing is it's a very volatile stock, so that does play into the hand of people that are shorting the stock. We do see, like Tevis mentioned, people go in and out of short positions. They're not necessarily holding for a year, 2 years, 3 years. They're just looking to make a buck. So it could be that a number of people actually are just trading it as short, or then they go and they switch long once it gets to a certain point. It is kind of a trader's paradise just because of that volatility. The other factor is there is a bear case out there that banks and SoFi as well will not do well in the era of falling interest rates. I don't really see what they see, but yeah, if somebody's actually evaluating SoFi, they're just a bank. There's nothing more to it than that. They're just a bit overvalued based on their price to book compared to the traditional bank, I think, at least when I was looking at it earlier last week. But I think that they're just missing that there's a whole lot more to this company than being just a bank. It's also growing very rapidly, has an amazing product suite. The flywheel is working. Member growth is phenomenal. They have 3 different facets for their main income, which is diversified so that it's resilient even if the macro sours. Like, people are missing it. And actually, so I was on the Spaces a few days ago, and normally these guys cover energy, but they occasionally invite me in for some fintech things. And I shared a few things with SoFi because it was interesting. It had run up a good bit at that point. And it was the first time many of the folks there had heard about the company. And so one of those things, like when you first look at a company, there's nuances, right? There's things that you'll look at and you'll be like, that doesn't look right. That doesn't look good. So one of those pieces was on free cash flow. If you look at SoFi or really most banks for free cash flow, it's problematic. Like it's one of my favorite measures. Stephen, if he was here, he'd say the same thing. But you can't really use it to judge SoFi just because of the way that those loans and those customer deposits look like. And Chris did a good job kind of writing up a bit about it. And I think there's a longer article coming out. But as first time investors, first time people are looking at that, they might look at that and say, okay, this is incredibly overvalued. This is just stupid. And then taking a small short position. It's dangerous.
I mean, so a couple things, right? The chat is also highlighting it. Like, it's a high retail name. It's fairly liquid. We don't know how long a lot of these shorts are in, whether this is a long period of time that they're shorting or whether they're in and out on any given week or month. A lot of people are taking them at face value when they've said that their lending segment is going to fall as well. It's the same people who are like, oh, well, SoFi relative to JP Morgan, if we look at tangible book value is, and you're like, dude, like they're growing like 40% a year. Can't value them like that. I think those are the same people who are going to make the argument to say, well, their lending is actually going to fall, and their lending was their biggest contributor to revenue. That was 60 something percent of revenue in 2023. And so actually this is a broken growth story, or it's going to be more evident in the coming quarters that it is a broken growth story. We can read between the lines and know that that was a sandbag guidance, and that's actually not going to be the case. I've been saying for ever since the Q4 earnings came out that I think lending is going to be flat to single-digit percentage up because the macro is not going to be as bad, and the macro is a serious undertone for their guidance.
I love selling covered calls on my positions and do quite well with that. I have not been on SoFi for a couple of weeks now. The valuation's down low, the premiums just have not been there, and I'm not willing to risk some upside gain on pennies on the dollar right now with the short interest being like it is. Some people will, and that's great. And I could be wrong, but I think that there may be a moment where the shorts get caught red-handed. It's undervalued at 9. I'll say that. I don't know if it's the best out there of all the possible names, but it's the one I'm buying. And every single week, I think is it 7 weeks in a row or 6 weeks in a row? I've been buying SoFi. There's no other position I own that I've bought consistently all through those weeks. And I've been trimming and taking some. Actually, I sold a little bit of Robinhood, about 10% of the position yesterday. And guess where that's going next week? SoFi.
There you go. We got the 10K information. The loan numbers we finally got. Personal loans, home loans, student loans, credit cards. Kind of diving into the 10K a little bit. Do you guys know what the credit card default rates are? Credit cards was like 18% before. Okay. It was as high as 20%. Do we know what it was this quarter? 15.5%. Now I sound like a downer, but it's improving.
You're so bearish, Tannor. Come on. No,
I'm excited. They are making great strides in the credit cards. Remember, you can't just wipe away all the existing clients. We still have a bunch of high-risk clients that are on the book. The new people that we're trying to, I guess, issue these cards to are of better quality, and we're going to continue to try to rotate out of those extremely low FICOs. It's really, really weird how many credit cards SoFi has given out over the last year and a half of people under FICO, like under the FICOs of 599. Unacceptable, in my opinion, whenever you're talking about having clients that are supposed to be really, really high end.
PayPal did the same thing under Schulman. And I mean, it wasn't just his decision as recently as like midway through quarter 3, and they had very high default rates on those merchant loans, and so they actually had to pull that back and revise that. And I've seen that a couple other places as well. So credit cards is one of a couple of platforms and that I've not been impressed so far in the execution, but that's making headway. So we got to give it time. Well, so the other thing too with credit cards, it's been a little while since I was on the website looking for those. They were not easy to find. So I don't know if that's a factor too, where it's just kind of hidden off in a corner. Maybe they just are offering it to people that are through advertising or something that are credible. But I'm not one of those people, I guess. I'm not good enough. I don't know.
Let's look at the last 4 quarters or so of credit cards. So I'll start with Q4 of 2022 and work my way through. You tell me if there's a change of pace here. Last year, 17,500 new credit cards issued. The next quarter after that, 22,000 new credit cards. Next quarter after that, 20,200. Next quarter after that, 22,500. This most recent quarter, 9,500.
There it is.
So I honestly think that they're resetting, taking a new approach.
But either way, I mean, credit cards is a very small percentage of their business. We know that alongside invest are two areas that they're just losing money on. So, I mean, you could have seen it also from this last quarter as they drove towards that profitability, that was an easy thing for them to cut that risk. It'll be interesting to see how that evolves throughout this upcoming year.
Yeah, I'm really excited to see because credit cards are really, really profitable if done right. But obviously, it's a risky business. I'm surprised you trim Hood. I'm like looking for entry into Hood right now, not trimming.
So I took gains last May on the position. And so it's all house money at this point.
Yeah.
But I decided to take just 10% off the table. I've been selling puts on some miners, crypto miners. How strong that correlation is between Robinhood and crypto, it's stronger than it should be. Like if you look at their actual revenues and the way it pumps just right along with Bitcoin, it actually has a stronger correlation than most miners, which is crazy. But I mean, it is what it is. And so seeing the weakness in the miners this week and looking at Bitcoin, I think Bitcoin will continue to pump and Robinhood will do quite well. But I'm like, I'm going to regret more if Robinhood falls back to 12 or 13 and not having any capital to rebuy that or buy some SoFi here versus some extra profits that I might have missed out of. I mean, I'm up 300%. And so I was like, I'm going to take 10% off the table. But yeah, the rest I can let ride now. I don't have to worry about that. Like Robinhood's so freaking exciting right now. I've never considered going long on Robinhood, just hitting it this year. It's a unique confluence of events that line up perfectly in 2024, and I'm seeing it play out actually even better so far than I expected. So, I'm not crying too much over that. But they have such a strong suite of products that are very well integrated. They ship them out very, very well. And then this 1099 gig economy that they're going after. It's very exciting that they're aggressively going after this. They just have 3 partners to start off the bat.
One thing that people don't appreciate in Robinhood right now is how fast they can accelerate their growth and lower their customer acquisition costs. During hot markets, brings a lot of retail investors, brings a lot of money in trading. Robinhood can double their revenue if trading on their platform doubles. The math is easy. But now they have this new, I want to say, gig economy platform where they're going after partnerships with Grubhub, GoPuff, TaskRabbit, massive gig economy players and saying, hey, we're going to integrate with them. Whenever those people are making a certain amount, we're going to offer them the ability to invest with Robinhood because this is becoming a real political issue with the gig economy is that these people aren't planning for the retirement. Robinhood is helping gig economy companies politically. They're doing what Shopify does, partner for all, because they won't need to create their own solution. Honestly, if you saw a stock come onto the market saying they offer what Robinhood just added onto their platform, that would be an entire multi-billion-dollar company. The company that helps gig economy and creator economies with their financial retirement plans. Robinhood is taking the infrastructure that they already have, the platform that they already have, and offering this ability to acquire new customers and invest directly through those platforms, and then cross-sell those customers into potential long-term clients for other products other than their retirement accounts. But the retirement account is the most exciting for me. It's the one where you can see the longest benefit for Robinhood and really adds a floor, in my opinion, to the stock price. That's what I'm really getting excited about with their acceleration in retirement and in gold. The trading fluctuation for SoFi or for Robinhood was just so high. If the markets were great, they'd make a ton. And then whenever they were bad, they would crap out. And you kind of get this extremely volatile stock. But with retirement accounts and these gold $5 a month plans, they're making consistent revenue, and it will change the way that the stock is valued, and you're seeing it.
There's just a bunch of volatility, I feel like, in Robinhood inherent in their business model. We're going into a volatile period, so I get it. But in the next down market, they're going to be the same as they performed in 2022. And that's not a today
because
problem.
they have a floor now.
Not necessarily.
They have $7 billion and they have those retirement accounts that are not disappearing. And then as they're bringing in those new retirees, these people are getting used to the Robinhood interface, and user interface is really, really good. When you're used to something, even if it's not great, unless there's something very, very attractive and compelling about switching, you don't. These people are, many of them are going to be Robinhood customers for life. So they've done exceptional in acquiring new users. And this is without the UK coming online, which is starting this quarter. I've seen some indications of that. But I agree, it's a cyclical stock. That's one of the things that the market's starting to realize that now. I realized that a while ago. That's why I went in somewhat heavy in Robinhood with those leaps, but it's going to do very well this cycle. And you're right. When the markets aren't doing quite as well, crypto's not roaring, it'll still have a floor. It'll be okay. It'll do what Robinhood did. You're right. In 2022, at a much higher level, it'll just kind of be flat, up and down, trade in the range until the next cycle. But me personally, like with what the changes that they're doing, the product suites that they're rolling out, the level of execution, like if we get a pullback, I might just buy some shares and go long, honestly.
First of all, I'm not bearish on Robinhood at all. Like I'm just on the sidelines. And I think the point that you brought up, like all of these points were still evident when Robinhood was like a $10 stock, $8 stock. Like they still had $7 billion in cash. They still had the European expansion. They still had a lot of these initiatives. It's the same problem that Coinbase has, right? With crypto. It's the volatility of the underlying market because their main revenue is transaction revenue.
Their gold platform is doing much better than I would ever have anticipated. They have an appetite to acquire companies and integrate them quickly. They're becoming a full service platform, and I know how to gauge, or at least I'd like to think I know how to gauge companies like that. Now they're adding on additional services. The difference between Coinbase is the take rate might come down and they have to fill that gap with ancillary products. Robinhood, the ancillary products are additive to the business, not replacing old high commissions. Everyone knows equities are booming. I'm in the very big camp of Anthony Noto that retail is going to have a much more hands-on approach to their own financial future. We don't need mutual funds. I think it is a different story than back whenever it was $8. They're offering new products that they didn't offer before. They're expanding globally.
Is it just that one earnings report then that completely changed the growth story in your mind? I think that's the only incremental piece of data that we've gotten.
It's been the last two earnings for me. As their earnings came out and surprised me in multiple ways, I've just shifted my focus. I think they've become a very mature company. Their stock-based compensation has really changed. Like the way, Vlad Tenev and his partner, I forget what his name is, have cut their stock options. I just think, and if we do go into a full market, like broad market, not just the Meg 6, you're going to see a lot of transaction revenue for Robinhood. A lot.
My thesis was a golden confluence. So you got crypto firing on all cylinders, equities firing on all cylinders, and you still have high interest rates. So you have all those flowing together. And it's like, hey, 2024 is going to be the year, maybe into 2025 a bit, and then I'm out. I'm done. Like they'll do well, I think, in the future. Two things change for me. One is just what they have been able to accomplish really since they've done their IPO, as far as the products that they shipped out, the developments that they've led with. I know that they're the leader in this space, like just frankly, as far as innovation, that they will launch something and then others will copy later. Almost everything that they launch is a very good, very credible product. Then you see like the X1 credit card platform, like it being tantalizingly offered. These are products that they have a high success rate with their products. What they're getting, and
it'll be interesting though to see that though. That's a different product. That's lending.
Oh yeah. It's a different product, but like looking at the whole history and then what they've done this year and with the launches, what they've been able to ship and do consistently time and time again is incredible. In quarter four, the operational costs, they've been promising this, they've continued to control this. Even the cost of acquisition was lower than I expected. They're just being very, very efficient. They're being very wise with how, and I looked back at the year. They had two acquisitions, X1 was a big one, and they had another that was smaller. So they've been very, very conscious with how they actually spend their massive war chest of $7 billion. And it's not just because they're trying to rake in the high interest rates. They alluded to being open to acquiring more as they go through the year. When Vlad has said that in the past, that is not just maybe we'll do it, maybe we won't. We're in talks right now and we're looking at something.
Yeah.
And just the level of execution, be able to do that and actually integrate the products in the past is very good. And so I'm comparing the culture of Hood and PayPal, and I'm like, in the past, I think Chris is changing that. Okay, I got to give more credit to the management. It's actually better than I thought. And then the last piece is what Tannor largely talked about is doubling and then tripling down on the retirement accounts. That is what will weather them through the storm. That these people, yes, they're locked up, for the year using gold. They can move off after that if they want to. I don't know that many will actually want to. Robinhood offers an amazing suite of services. A lot of these people they'll be here to stay. They love the user interface. It's easy to use. It's easy to understand. The learning tools are all right there, and they're always adding and innovating other things on. This is a very different push than Robinhood had back in the previous bull cycle. Well, seeing internal communication like Vlad and then like Robinhood's actual X platform saying there's an incredible demand for a product. if you have an appointment with us to actually transfer your account over, you need to keep it, or it might be 2 or 3 weeks later that we actually get to you. There's a stronger long-term bull case and thesis that I gave them credit for.
One thing to take away as well is that one retirement account is not the same as one regular transacting account for people's day-to-day trades. It should be worth much, much more. So the
Yeah,
shift is very exciting.
the thing that I think about when with regards to the retirement accounts is like, what is the take rate of those, like of that product line? Simply because it seems to me that it's a little bit skewed outside of their core target demographic. Their core target demographic being young people who want to trade, as opposed to the Matt Moneys of the world who are doing dividend investing for the long term, or probably not doing it on Robinhood. But if
That's
I'm buying options contracts and YOLOing and if I'm on Wall Street bets, then yeah, I'm going to be on Robinhood. But generally, I'm not going to be buying Robinhood's retirement product because like that's not what I'm on Robinhood for.
They answered this in their most recent earnings call. Average account that came over had more than 6 figures in it, which is what they said. So they are much, much larger accounts. They said the average person that was coming over for their retirement accounts are larger. I forget what the ratio was, but they're much, much larger than their traditional accounts that they have today. Ladies and gentlemen, thank you so much for watching.